Why do student investors make irrational decisions? Imagine being excited about your first investment and rushing into trades without thinking. That rush of adrenaline can lead to choices that don't make sense in the long run. Many student investors fall into the trap of emotional reactions and mental shortcuts instead of sticking to solid plans. Behavioral finance shows that human feelings and thinking biases heavily influence how we invest. For students, these biases are often stronger because they have less experience and limited financial knowledge. One common bias is overconfidence. Students tend to believe they know more than they actually do. They might think they can beat the market or pick winning stocks easily, which leads to taking bigger risks than they should. This is called the beginner's overconfidence effect. Because they've learned a little about investing, they feel more confident, but they might not understand the full picture. Another issue is herd mentality. Students often follow what their friends or popular trends are doing. If everyone is buying a certain stock, they might jump in too, even if it's at a high price. This can cause buying at the worst times or selling during drops, which hurts their growth. Loss aversion is also common. The fear of losing money can make students hold onto losing investments too long or sell winning ones too early. Emotional reactions to losses can cloud judgment and lead to poor decisions. Recency bias is when students focus too much on recent events. If the market just went up or down sharply, they might make impulsive moves based only on recent trends instead of thinking about the bigger picture. Anchoring and confirmation bias happen when students cling to initial information or beliefs. They might ignore new data that contradicts what they first thought, which can cause mistakes. Limited capital and less experience make these biases worse. If students don't have much money invested, they might take bigger risks or panic more easily. Superficial financial education can also give a false sense of confidence, making them overestimate their skills. To avoid these pitfalls, students should become aware of their biases. They should focus on learning critical thinking and understanding their emotional reactions. Creating a clear, long-term investment plan helps avoid impulsive decisions. Consulting experienced mentors can provide perspective and prevent common mistakes. Patience is key. Resisting the urge to trade based on emotions or peer pressure can lead to better results. In the end, irrational decisions often come from a mix of psychological biases and limited experience. Recognizing these influences and sticking to disciplined strategies can help students make smarter, more rational choices as they grow their investments.